Hey, welcome back to Compounding Quietly. Most investors never stop to ask whether they are paying too much for the same outcome. You have probably had QQQ in mind as the answer for growth investing for a long time. But the case for SCHG is quieter and more compelling than most people realize. Let's get into it. Growth investing has a default answer for most people. When someone says they want long-term exposure to U.S. technology and innovation, the first name that comes up is almost always QQQ. And that makes sense. QQQ has a long and visible track record. It is widely discussed, widely held, and it shows up in nearly every portfolio conversation about growth. It has become the shorthand for the entire category, but familiarity is not the same as fit. And right now, a growing number of long-term investors are quietly starting to ask a different question. Not whether QQQ is a good fund, but whether it is the right structure for what they are trying to build. That shift in framing matters more than it might seem on the surface. Think about how most investors end up choosing a growth ETF. They hear a name enough times. They see the performance chart and recognize the major holdings. They notice it is already in everyone else's portfolio, and that social proof starts to feel like due diligence. It is not. Real due diligence means asking whether the logic underneath the ETF actually matches the thesis you are building toward. Most investors never take that step, not because they are careless, but because no one framed it as a step worth taking. So let us take that step today. The concern that tends to surface when investors slow down and look carefully at QQQ is not about past performance. It is about structure. And structure is what determines what you are actually holding over, the long term, and why. The first thing to understand about QQQ is that it is an exchange-defined index. QQQ tracks the NASDAQ 100, the 100 largest non-financial companies listed on the NASDAQ exchange. The key word is listed. The selection logic is based on where a company chose to register its shares, not on whether it demonstrates specific growth characteristics, not on earnings momentum, or revenue, expansion rates, or projected cash flow growth, just on market capitalization within one exchange. Most of the time, the largest NASDAQ-listed companies happen to be technology and innovation-driven businesses. So the portfolio looks like a growth fund, and it has behaved like one over long periods. But the underlying logic is an exchange membership filter, not a growth screen. For most investors, that distinction never becomes visible because the result looks exactly like what they expected. But when you are building a position designed to compound over 20 or 30 years, the selection logic is worth understanding clearly. It shapes what you own and what you cannot own, regardless of how strong a company becomes. SCHG takes a different approach. SCHG, the Schwab U.S. Large Cap Growth ETF, screens companies across the entire U.S. large cap market for actual growth characteristics. Not just the NASDAQ, the full large cap universe. The screen evaluates things like projected earnings growth and historical sales growth rates. That means SCHG's portfolio is defined by what a company is doing financially, not by where it chose to list its stock. The result is a portfolio that looks very familiar at the top. The same dominant technology companies appear in both QQQ and SCHG. The overlap among the largest holdings is significant. The names you already know are there, but below the top 10, the composition starts to diverge in ways that have long-term implications. SCHG holds roughly 250 stocks, drawn from across the full U.S. large cap growth universe. QQQ holds 100, and every one of them is NASDAQ listed. That difference in breadth means SCHG can capture growth. Companies that listed on the NYSE or other exchanges. Companies that would never appear inside QQQ, not because of weak fundamentals, but simply because of where they listed. A company with strong earnings growth and expanding margins, but listed outside the NASDAQ, simply does not exist inside QQQ's portfolio. SCHG finds it anyway. Now, here is the honest reaction most investors have when they first see this comparison. They pull up the performance charts for both funds, and the difference looks relatively modest across many periods. So they think if the outcome looks similar, does the structure really matter that much? It does, for two reasons. The first is cost. QQQ carries a meaningfully higher expense ratio than SCHG. That gap may look small in any single year, but over a 20-year compounding period, the cumulative difference in what gets quietly deducted from your returns is easy to underestimate. Compounding works in both directions. A lower expense ratio is not just a small advantage. It is a structural edge that runs quietly in your favor every year for as long as you hold the position. The second reason is coverage. If your long-term thesis is U.S. large cap growth, the scope of that thesis matters. Limiting the portfolio to one exchange means you are only capturing the NASDAQ portion of that story. SCHG does not limit it. It follows the growth characteristic, wherever it appears across the full large cap market. Coming back to the original question, is SCHG a better choice than QQQ? That is actually the wrong framing. The better question is whether the structure of each ETF matches the thesis you are trying to carry forward. If your conviction is specifically tied to NASDAQ-listed innovation, QQQ is the more precise instrument. If your conviction is about U.S. large cap growth more broadly, SCHG makes a compelling case. Lower costs and wider coverage are structural advantages that compound over time. These are not competing answers. They are answers to different questions, and knowing which question you are actually asking is what separates a deliberate position from an inherited one. Here is what I want you to hold on to. The investors who build the most durable, long-term positions are not always the ones who found the most recognizable ticker. They are the ones who understood what they were holding and why they were holding it. That understanding does not require advanced financial knowledge. It requires one honest question asked before you commit capital. What am I actually trying to build? And does the structure of this investment genuinely serve that goal? When QQQ comes up in every conversation about growth, it becomes easy to treat it as the default answer for the category. But defaults are not chosen, they are inherited. And building a portfolio through inherited defaults, rather than deliberate intention, is one of the quieter mistakes long-term investors make. Not dramatic, not visible in any single year. But over decades, the compounding of unexamined assumptions can quietly separate an adequate outcome from a genuinely strong one. If you have held QQQ for years and feel comfortable with the structure, that is a valid and reasonable position. This conversation is not about switching. It is about knowing. And if you have not yet looked carefully at SCHG as a long-term alternative, it is worth taking the time. Not as a replacement for your thesis, but as a potentially more efficient structure to carry it forward. Clarity about structure is part of what makes a position stable. When markets get uncomfortable, when volatility arrives, the investors who stay calm are not always the ones with the highest returns. They are the ones who understand what they own well enough that the movement does not surprise them. They built with intention, and intention gives you something to hold on to when everything else feels uncertain. That is the standard worth bringing to your next investment decision. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.